Welcome, everybody. It's great to see you all here this evening. We're, for our regular attendees, we often are doing our events at 11 o'clock on Tuesdays and Wednesdays, and so it's fun for us every once in a while to extend it into the evening and hopefully get some people who can't come in the middle of the day, and particularly for people active in business in a town that increasingly has a lot of financial activity. We thought this would be a great topic for a twilight version of the Miller Center Presents. We've seen a remarkable evolution in both cryptocurrency and in the blockchain technology in recent years. The potential for this technology is immense, and the applications, certainly in financial markets and beyond it, are extraordinary, as I learned in the green room before coming in and talking about it and what little reading I'm doing. And we have a terrific panel today who's going to explore this for us. Our discussions are going to be led by Chris Liu, who is the Teresa Sullivan Practitioner Senior Fellow here at the Miller Center. For those of you who have met and seen Chris before, you know that we are really lucky to have him on our team and with us. For those who don't, and I know you have bios with you, but just quickly, his 20-year career in public service is extraordinary. He's worked in all three branches of the federal government, including 7 years in the Obama administration. From 2014 to 2017, he served as Deputy Secretary of Labor. And you may wonder, why is somebody in labor here talking about finance at Capitol? Well, Chris was the CEO of the department with 17,000 employees and a $12 billion budget. And in that job, he looked at a huge range of issues, including things like, are we going to a worker-free world, given artificial intelligence and other advances in technology? And given his broader background in government and public service, for Chris to be working with us on a topic like this is not surprising. From 2009 to 2013, Chris was the White House Cabinet Secretary and Assistant to the President. Now, we hear of Cabinet Secretaries for different cabinet agencies. What Chris did was coordinate all of the cabinet secretaries for the President of the United States. It's an extraordinarily important job. It's essentially an extension of the Chief of Staff's office, where you're managing the biggest pieces of the federal government. Chris got to that job having first worked for then Senator Obama, first as his legislative director and then as his acting Chief of Staff during the 2008 election. And then the day after the election, Chris became the executive director of President-elect Obama's transition, overseeing the biggest takeover in the world. That is the transition from one president to another. President Obama said of Chris, through his dedication and tireless efforts, Chris has overseen one of the most stable and effective cabinets in history, a cabinet that has produced extraordinary accomplishments over the president's first 4 years. He is the second Asian American in history to become a deputy secretary of any cabinet department. He co-chaired the White House Initiative on Asian Americans and Pacific Islanders. And prior to all of that, Chris spent 8 years working for Representative Henry Waxman as deputy chief counsel of the House Oversight and Government Reform Committee. And before that, he served under Judge Robert Cowen on the U.S. Federal Court of Appeals for the Third Circuit, and comes to us with an undergraduate degree from Princeton University and a law degree from Harvard. Chris has been a senior fellow with us for coming up on 2 years now, since when he left the Obama administration, and we are really delighted to have him with us and have him with us here today to introduce our panelists. And after the presentation, to moderate a conversation amongst them and then with all of you. So, Chris, thank you.
Great. Thank you, Bill, and welcome all to the Miller Center for this exciting panel discussion. As Bill mentioned, I'm honored to be a senior fellow here. I'm also a little bit of a recovering politician. When I'm not at the Miller Center, I spend part of my time as a senior advisor to a tech company called Fiscal Note, which is looking at how artificial intelligence can be used to better understand what government is doing. So I'm kind of making this transition, which is one of the reasons why I am moderating today's discussion. I'm also proud that I am the owner of $125 of Bitcoin. My wife often jokes, like, if you're going to use Bitcoin to conduct some kind of illicit activity, you probably need more than $125. It was $125 before it went down a lot. So this is a topic that I've tried to understand, both the opportunities and the challenges. And I know there's different levels of understanding in the room. And our goal at the end is that everyone has a basic understanding of not only cryptocurrency, blockchain more broadly, as well as what the implications of this are for the future. So we've got an exciting panel. So let me introduce them from your right to your left. You have full bios, so I will just do a quick introduction. We have Jacob Duda to your right. Jacob is with Goldman Sachs Investment Strategy Group, was previously with Pyra Energy Group. Jacob, I found this interesting, it's in your bio, has published 22 research papers on pure mathematics, which I'm sort of guessing is 22 more than, well, I was going to say 22 more than the people on the panel, but it may be 22 more than anyone in this room as well. It's a lot. Yeah. Next, we have Carol LaPointe, who's a senior fellow at the Georgetown University Beck Center. She previously served as the interim director of the President's Commission on White House Fellowships, which, as you may know, is one of sort of the crown jewels in the federal government. And she calls herself a futurist, which I think is pretty cool. It's kind of like the opposite of being a historian, I guess, as you're looking forward instead of backwards. And then finally, from our university, we have Yorgos Alianis. Close? Close, close.
Very close.
very. Bill spent some serious time tutoring me on this, and Alianis. He is the Paul Tudor Jones Chair in Business Administration and the Associate Dean of the Darden School's Global Executive MBA program. So we have until 7:30, so about an hour. So the way we're going to do this is Jacob is going to do a presentation that's probably going to last about 20 minutes that I think will level set everybody on what cryptocurrency is, and then an introduction to blockchain. Then we will have the panelists provide their perspectives on this issue, and then we'll do a little bit of Q&A up here, and then the goal is to leave about 20 minutes of questions from the audience. So with that, Jacob.
Thank you very much. Thank you very much for the invitation, and I'll try to talk about this amazing new technology that came about in about 2008, and we have seen a huge development, and we will see more of it in the future. So with that, let me try to refocus With that, what are the key takeaways for us? Well, what we think is that the blockchain technology is revolutionary, and it's going to have very large impact on many endeavors on many industrial areas, on many financial institutions, on many financial systems. It will cause a revolution. The cryptocurrency ecosystem as it is today, we don't really see the current incarnations of the cryptocurrencies to persist in their form, because all of them have certain problems. They have scalability issues. You know, we are at a very nascent stage of this whole endeavor. So all of the cryptocurrencies that exist today will have to sort of evolve a little bit more to serve even the purpose that they're trying to solve. And finally, I think the biggest threat to cryptocurrencies themselves, we see that central banks will step in and provide their own version of the cryptocurrencies. So that would sort of lower the need for the alternative cryptocurrencies to exist. So with that, let's put everything into perspective. So the Bitcoin, which was the first cryptocurrency, was invented in 2008 by an anonymous inventor known as Satoshi Nakamoto. There's been many attempts to uncover the identity. Some of them have been spectacular failures, and you can read about that. It's very, very amazing history. But we still don't know who Satoshi Nakamoto is. Since then, we have about 2,000 cryptocurrencies that came into existence. We have more than 300 focused funds that looked at cryptocurrencies, and we have more than 200 exchanges globally. So originally, when we started looking at the cryptocurrencies, it was in 2013, 2014. Everybody said, oh, well, you know, Bitcoin is great, but what about the technology? And everybody got really excited about the new technology prospects. And then there was this explosion in the prices of Bitcoin and other cryptocurrencies. And everybody we talked to said, oh, forget about the technology for now, but is it an asset class? Is there a bubble? What can you tell us? And then in November of 2017, we had a presentation, and we said, well, we think the cryptocurrencies are in bubbly territory. There's going to be a renormalization, and I'll show you some slides later to put things in perspective. And indeed, since then we have come down significantly from the peaks. Let me move forward. So what's the blockchain technology? So the blockchain technology is the underlying technology that allows the cryptocurrencies to work. And let me try to explain it in a simple way. A centralized network depends on the central node. So if anybody wants to know what the reality is, they ask the central node provides the information. Everybody has the same vision of reality. Everybody agrees on what the reality looks like. What's amazing about the blockchain technology, it allows us to have the same function, the same modus of operating in a distributed network. And what it does is, if the whole distributed network can agree on one version of reality, maybe with some small delay, but eventually everybody will have the same version of a ledger, of the shared information, then it becomes extremely resilient, because I can take away half of the nodes. I can take 2/3 of the nodes of the network, and it will still function. It's extremely persistent, resilient, and it functions under duress very well. In fact, if there's only one computer in the world that will run the Bitcoin protocol, we can still have operating Bitcoin. It's almost impossible to kill Bitcoin in that respect. So the blockchain is the critical infrastructure. It's a public distributed network that basically serves as a ledger for all the transactions, for all the value that's stored there, but it can be used for many, many things. It can be used as a store of information. It can be used as a store of value in a second layer, or it can even be used to conduct certain transactions in an automated way. And we will talk about the consequences of smart contracts, all of these exciting new technologies later. Okay, so the blockchain technology holds tremendous potential, as we said. Let's look at three applications quickly. One of them is settlements of transactions in financial markets. Today, if you trade equities, let's say in the US, the settlement takes 2 days. If all of this could be moved into the digital domain on the blockchain, maybe the settlement could be instantaneous. Currently, we have the value represented in the blockchain with the Bitcoin or with some other cryptocurrency, but what we would have to do is also represent the ownership of the stocks there. But if we have both of those information represented in the blockchain, we could instantaneously settle transactions. Another example from the same area would be cross-border transfers. Today, if you want to send cross-border transfers, there's several steps that has to be taken. You want to transfer money from the US to some other country internationally. It will take something like 2 days. Several banks will be involved along the way. If this could be done in a global distributed network, it can be done almost instantaneously. The other application that we can look at is the identity. So when the internet came about, it was mostly a network for sharing information. Nobody was worried too much about privacy, security, safe transactions, banking transactions, etc. It was largely an academic endeavor that eventually evolved. Then came the internet of 2.0, the new era of the so-called walled gardens. So now we could do secure things, but if I want to interact with one entity on the internet, I have to create an account with one company, with Facebook. And then I want to interact with Google as well. I want to have email with Google. I have to create another account. So I have to manage my identity with every single counterparty on the internet. So I have to have hundreds of accounts to be able to do what I want to do on the internet. One of the potential applications of blockchains is digital identity. And the idea is we would have one digital identity online, and I would selectively allow the counterparties in the digital domain to access the information. For example, I want to rent a car. I would have complete control over my identity. It's all encrypted using the cryptography, and it's secure. And I would selectively provide only the information that I want to provide to the third party. I want to borrow a car. I would provide them the history of my insurance contracts and all my accidents before, etc. So that would allow me to take over the control of my identity. I would just have one identity, and I could manage it centrally. And then the third application is supply chain management. I think Kara is going to talk about that application mainly. What this allows is radical transparency. I could track, let's say I would have an orange, it will get a tag the moment it gets picked up, and I could track it all the way through the supply chain. Along the supply chain, they would scan the tag, that information would get posted on the internet, onto the blockchain, and it would be available all throughout the chain to the consumer. So the consumer would know where the orange came from. You can imagine many other applications, like if I have a fleet of trucks and I want to buy the company that owns the fleet of trucks, if all the history of those fleet of trucks is on the internet, I want to do my due diligence, I'll ask the company I want to purchase, they'll give me access to that information, they'll give me the password, I can verify the whole history, so I can do much more due diligence than I could do without that technology being available. So those are 3 applications of the blockchain technology. The technology has a tremendous potential, as I mentioned, but it will take time. Our colleagues at GIR, the Goldman Sachs Investment Research, expect it to be adopted selectively over the next 2 to 5 years, but the broader acceptance will take much longer, 5 to 10 years. In the financial services, we expect even a slower adoption because basically there's a lot of regulatory oversight and other hurdles that have to be overcome. And as you can see on the third chart, the regulatory uncertainty is one of the biggest hurdles, especially for adoption of all these new technologies into practice. So now, what is a cryptocurrency, and why is the technology important? So what are its attributes? Like, cryptocurrency is a currency which is natively digital. It's something where the value is completely represented in the digital domain. So it's native to the digital domain. All of the value is stored there. So that's one of the main properties that it has. It's completely decentralized. So that's that picture of a distributed network. There's no one central controlling entity that would have impact over the whole network. It's open source. Why is that important? In cryptography, there's always a lot of debate how cryptography should work, etc. The best practice currently among the experts is the security should be in the data, not in the code. So you have the computer code that does the computations, and then you have a data which is your private key that represents you or represents your security. So the view is all the security should be in the data, not in the code. The code should be open source. What does it achieve? When you write a computer program, you publish it to the whole world. So you have potentially everybody can attack it and find bugs. So you have resources that are unimaginable for any company to provide to help you find bugs in your code. And if the whole community is contributing, then it's much more safe to use that sort of code, because if there were any problems, it would have been found out. So that's why it's important to be open source. Distributed consensus. That's one of the problems that the blockchain technology helped to solve. There were really, the problem with having a distributed database is how do we make sure everybody agrees on the same version of reality, maybe with some delay, but eventually we need to agree on who bought this stock from whom, who made this payment to whom. So this is what the blockchain distributed technology achieves. Pseudonymity, well, it's the property, for example, of Bitcoin. There are other kinds of cryptocurrencies that provide different properties, but the main cryptocurrencies are pseudonymous. And what it means is I'm not anonymous on the network. I'm represented there somehow because I want to do transactions. I have to have a representation, but the representation is some string of numbers. It's my public address, public key. And when I transact, I'm using that key. So as long as I don't link that key to my physical identity, nobody knows who I am. But all the transactions that I've ever done will be linked to that key. The moment you manage to link that identity to a real person, then you cease to be anonymous in those dealings. That's why for example, Bitcoin stopped being used for illicit transactions, because the moment you manage to link that public address to somebody's identity, you can trace all the historical transactions that they've ever done, and that is a problem if you're trying to do illicit activities. And finally, there's cryptography. So cryptography is the mechanism that allows the security. Really, the protocols that are being used have been known since the 70s, but it's the cryptography plus the distributed nature of the of the blockchain, plus the sort of incentive mechanism, that all these three came together to create the Bitcoin, the cryptocurrency, which sort of these three sides of the triangle kind of managed to achieve something that wasn't possible previously with the existing technology. So what is mining? So I'll first talk about in the Bitcoin blockchain, if I want to pay somebody, how do I do that? Well, I have my address, and I have my public address and private address. If I have my public key and private key. If I know my private key, I can post a transaction to pay from my public address to somebody else's address. So I publish it to the network. The miners will pick it up. Somebody will put it into the next block, and it will become a transaction on the blockchain. How do I have the money to begin with? Well, somebody has to have paid me originally to my public address. So I can only pay somebody if there was a before a transaction that attributes the value, the bitcoins to me. Now, how did the bitcoins came about? So different cryptocurrencies have different mechanisms of introducing the coins. For Bitcoin, the miners are all of these computers around the world that are making sure that the system is operating the way it should. There's no fraud, and they're effectively verifying the transactions. The way it works is they play a lottery. There's a certain lottery. They collect all the transactions that everybody wants to put into the next block, and then they try to wrap it up in a bag and put a digital seal on it. The only way you can put a digital seal on it is to solve a certain cryptographic puzzle. And the mathematics behind it shows us, under some assumptions, that there's no way to cheat. You have to go through all the possible combinations. There are not that many. It will take you about, it will take you a certain time, but you have to go through all the transactions, all the possibilities. Whoever comes with the winning entry immediately posts it to everybody else around the world. They say, I found the next block. Then it's linked to the blockchain. It has a cryptographic link to the previous node in the chain. And then, again, the next race begins. Everybody takes the transaction they've heard to the point to the point in time then, and then they try to lock it in the digital bag, which will become the next block on the blockchain. And crucially, when they do that, when they manage to put the stamp and broadcast it to the whole world, they're allowed to pay themselves a certain amount of Bitcoin. And that's the reward for mining, and that's how all the Bitcoin came about. So originally the reward was relatively high, and it keeps shrinking until all the rewards will be paid off. At that point, there'll be no reward for mining, but the idea is that the transaction costs will replace that. And so if I want to put a transaction on the blockchain, I can say I'll allocate a little bit to whoever puts that transaction on the blockchain. And if I really want to make sure, I can put slightly more. So I can pay a little bit more, and that way I'm making sure that whoever hears about my transaction is willing to put it in, because if they put it in, they'll pay themselves the transaction costs. That's the reward for the miner. So that will be how the mechanism will operate after all the rewards have been paid out. Let me just briefly mention ICOs. So in the real world, we have IPOs, initial public offerings. When a company wants to go public, they submit a prospectus. There's a well-known process. They attract investors. The initial investors invest, and then the company becomes public. ICOs are the digital analog of IPOs, but this has been a very, very unregulated space that have exploded. But in that space, it's well documented that there's been a lot of fraud, and there's been very little regulatory oversight. It's still, the rails are being put into place, etc. So it's been a mechanism that's been in place for a while, but we have seen that 20 to 70% of the transactions so far might have been scams. There's been a lot of research in that area. I'll leave it with that. There's a lot of risk for the buyer at the moment. Why did the cryptocurrencies rally so much? So we saw that picture in the first slide. We had explosion in price of Bitcoin, and similar things happened for other cryptocurrencies. Well, there was a perceived scarcity because Bitcoin there will only ever be 20 million Bitcoins that will be mined out. And once they're all mined out in a few years, there'll be no new ones. So that could have been one of the reasons. The other reason is it was perceived as digital gold. For some time, people started looking at it and said, "Oh, this is the next this is the digital gold," and so there was a flight to that security. And finally, since the ownership is not anonymous but pseudonymous, the illicit use has significantly fallen. There's been some academic research, and I think the Bitcoin has largely been stopped use for illicit transactions. There are some completely anonymous currencies that have replaced Bitcoin in that space. So again, it gained more legitimacy as it matured. So what is a currency? If you have some mechanism, how do you say it's a currency? Traditionally, economics has 3 questions that it asks. Is it a good medium of exchange? Is it a good unit of account? And is it a good store of value? Let's look at Bitcoin as an example. So the transaction fees, to put one transaction onto the blockchain, the average transaction in the second quarter of 2018 was about $1.33 in the US dollar equivalent. If you're going to go to Starbucks and buy a coffee, you're not going to post the transaction on the blockchain for $1.33. So it's good for large transactions, but it really wouldn't work for retail transactions at the moment. There are certain enhancements that are being considered, some like side chains where you'll do retail in a chain that's much more cheaper and efficient, and then maybe every once a month or so, all those transactions get posted onto the larger chain. So the larger chain is the big transaction chain, and then the smaller chains will kind of inherit the legitimacy from the larger chain. So there's some extensions proposed to solve that problem. The other question, is it a good unit of account? Well, the volatility of Bitcoin is 5 times the volatility of emerging market currencies. Even though it came down more recently, it's still relatively large. So with that large volatility, would you want to be paid in Bitcoin? Well, 1 month you get a salary, the next month you get half of it, the next month you get 4 times. It's not really a good unit of account in that respect because of the volatility. And then the third question is it a good store of value? Well, if you look at the drawdowns, historically, there have been very large drawdowns in Bitcoin, Ether, in all of the cryptocurrencies. So again, as a store of value, you would expect to have a relatively stable value in one sense or another. So if there are these large drawdowns, then that largely disqualifies it from being a currency. And again, so it's really not a currency in a way, so is it a commodity? So one way to look at if something is a commodity is to look at the marginal production costs. And so if you look at the crude oil, the marginal production cost is roughly in line with what the price is. If you look at gold, we have a similar story. For Bitcoin, again, this slide is a little bit dated, but the dislocation between the price and the mining cost is relatively large. If you think about the prices when we were in the bubble, close to $20,000, then we were very, very far from that. So if it's a commodity, then it's very, very far from sort of any sort of equilibrium in the economic sense. Have cryptocurrencies disrupted the payment processor? So is it a payment mechanism? Well, what we looked at is the market capitalization of Visa and MasterCard. And what happens with the payment processors is the market cap of the company is much smaller than the amount of transactions they process. But with Bitcoin, that ratio is much higher. So again, in this comparison, it doesn't pan out. So one historical slide to put things into perspective. We know there was an equity bubble in 2000, dot-com bust. If you now zoom in here, then here you see what happens in the Bitcoin bubble. So you have to go like one scale down. And then again, if you take this peak and then zoom in again, then you see what happened to Ethereum. So again, this is evidence that there was bubbly, risky behavior at some point, which is unprecedented from historical perspective. So let me conclude. What are the key cryptocurrency risks? Well, one of them we hear a lot is the hacking of the exchanges. So there's been a lot of money stolen in many different contexts. So to think about that, there's the underlying protocol that's open source, and that's very safe. That's never actually been hacked. And on the top of that, you have applications. Somebody builds an exchange, somebody builds an online store. If the hackers hack into the exchange and they steal the private keys, then they didn't really hack the protocol itself. They hacked the particular implementation. So there are layers of security. So the underlying protocol is safe, but the implementations are hard, and security is very hard to get right. Developments in quantum computing. Well, if quantum computing matures much faster to a degree that's much more powerful than today, then today's cryptographic methods won't be sufficient. That's the bad news. The good news is, if we have quantum computing and all of these amazing things, we can probably invent new ways of encrypting that will use the native quantum methods, and there are already some protocols around, so we would just have to basically move to version 2.0 of everything. Unintentional coding error. So that's linked to the hacking of exchanges. It's very, very hard to get things right and not to get hacked. As we've seen recently, Facebook accounts got hacked, Google accounts got hacked. It's very, very hard to get security right in the digital domain. Government regulation, again, I'm sure we'll talk about that later, but some of these currencies have complete anonymity, like Zcash, Monero. So that allows completely anonymous payments, which are completely untraceable. Once the money is gone, it's gone. That creates potential for criminal activity that has been seen before. You have ransomware. You can have slush funds that are completely anonymous. So it creates a lot of opportunity for very unethical behavior. And I'm sure Kara can talk in more detail about potential implications of all of those. So the question is, will government step in at some point and disrupt at least some of those cryptocurrencies? And then central bank disruption, I talked about at the beginning. Maybe the central banks will actually introduce their own digital money that will potentially be the future. Okay, so I'll conclude with some basic advantages and disadvantages of blockchains. Well, we have the security of the underlying protocol, which is great. We have the immutability that, like, once the chain has been created, it's impossible because of the cryptography, it's impossible to change the past. We have transparency. Everybody can look at the blockchain. Things can be encrypted there, but you can selectively provide keys to people to see the data. So it provides great amount of transparency. It's efficient. It's a distributed database, which everybody is forced to use one protocol. So all the systems are now forced to use one way of operating, which creates economy of scale. And then now the disadvantages, well, there are slower speeds because the distributed database, it will take some time before the consensus is reached. So it's not immediate. There's privacy. Distributed databases imply sharing. So the question is, like, how much do we want to share? Are we okay with sharing everything? Is this radical transparency something desirable in all contexts? We have the need of a network for all of this technology to operate. And then, as any technology project, setting things up from scratch or even from some prefabricated parts will be very costly, as all technology projects are. Okay, so I'll conclude with that, and
thank you.
We can start.
So Jacob, why don't you have a seat, and Jorgos, let me ask you. So Jacob just did a great job of sort of laying this out, talking about why Bitcoin isn't really a currency. So from your perspective, what are the applications? Where's the utility of this?
Right.
And let me ask you sort of a personal question. When I own $125 of Bitcoin, what am I actually owning? I mean, I can't touch it, I can't feel it, I can't see it. What do I own?
Yeah, I don't own any Bitcoin, so that gives you my answer. Interesting. My first thought was, and I haven't really gotten a clear answer on this. It's true. What is it that what problem is the Bitcoin solving? It's not currency, because you don't use it for transactions. I was reading somewhere there's only 7 transactions per second you can do with Bitcoin, and Visa and MasterCard are doing 20,000 per second. So a good line when I was teaching my class, the Bitcoin case, was are you ever going to use it to buy coffee at Starbucks? And I answered the question myself, and I said, no, because the coffee will be cold. By the time, you get your coffee and pay, it's going to be cold. So it's not a currency, right? So at least right now, it's not an asset, it's not a commodity exactly. And so the question is, what is it? And what is the exact problem? So the only thing I can think of is that, well, there's people who didn't want to be traced. So there's like this illicit things that Jacob was talking about. There's also other people who thought about, we don't want to have a government pumping money or taking money out. So, but that doesn't mean that there is any usefulness to the currency itself, right? Just an interesting thing. When you saw the Bitcoin, when you bought it, and let's say it was, I'll give you a good price. So let's say it was 10,000. So you only lost from 10,000 to 6,500. So did you know why it was 10,000? No. Same thing. Do you know why it was 6,500? No. And part of this is because if you think about an asset like a stock, and what we teach our MBAs is that a lot of those financial assets, you want to have a stream of cash flows, something that is going to give you in the future. For example, the stock gives you dividends, the bonds give you interest, right? And so the way we teach our MBAs is that you have all this stream of cash flows, and you basically bring them back to today, because $1 a year from now is less than $1 today. And so in the end, you have a value of an asset today based on the stream of future cash flows discounted to the present. But, with the Bitcoin, there's no cash flows, there's no interest, there's no dividend. And so a lot of people actually are not going to touch it because I have no idea what I'm buying. Now, the interesting thing is, because I also wrote a case on gold, I had no idea that I was going to write a case on Bitcoin as well when I wrote the case on gold. And then the question was, is it digital gold? And then immediately I think, if you think about, the nice thing about Bitcoin is that I can press a button and money goes somewhere, right? With gold, I have to carry the gold. It's heavy. So somebody can say it's better than gold, except now we have other technologies. What we do is we have something that's called ETF. That basically it's not quite like a mutual fund, but like a mutual fund that takes the value of gold. And you can just basically buy and sell this ETF like a stock. So we and it's all within a regulatory framework that is not present for Bitcoin. So a lot of stuff I said to answer your question. I have the same question myself. Is like, what is it that we're using the Bitcoin for? But one thing, and I'm just going to throw it out and then pause for later. What I was very interested and quite impressed, actually, it was with how quickly this infrastructure around digital currency developed. For a long time, it was only a few people who bought. Maybe you were one of them, but I was, I heard Bitcoin and then just filed it away and wrote a case on gold, wrote a case on something else, banks, and then there was something called the crisis. And then finally, all of a sudden, everybody was talking about Bitcoin. So I said, okay, I really have to understand what is going on. And, the thing is, I mean, it's still very difficult to understand why it exists, but yet we saw, you probably, of course, all of you know, the Chicago Mercantile Exchange, CME, the Chicago Board of Options. They were basically, in some ways, rushing last December to offer something that's called futures. A future is a financial product on Bitcoins. So you have two very respectable organizations. You could buy pork bellies there and some other stuff. And hugely respectable organizations that were offering these futures in Bitcoins. Then you got this whole other infrastructure on ICOs that Jacob was talking about. I mean, I'm impressed, and I tell my students, the best thing in the beginning is you have to find a good name. Imagine, IPO, ICO. Smells, looks, hears like IPO. Except, with the IPO, you get shares. And, as Jacob said, the firm has to do all kinds of declarations and go through regulatory filings before they tell you, okay, this share represents some cash flows to, I don't know, cookies that I'm going to sell in the future. Here with ICOs, many times it's an idea. It's like a white paper and a code. And the question is, how much can you tell from a white paper and a code? And you don't have the SEC sometimes around it. However, things are moving. So what happened is that you had a lot of people who had a code and an idea, and you were left with a coin. And you didn't know whether the coin was good or bad, essentially. And so now one interesting tidbit, and I'm going to stop here. One interesting tidbit is that actually ICOs, the SEC of course is on it, and it looks like these coins look and smell like securities. And once you have a security, that means that now we need a regulatory framework because you have a security and not just something that's called a coin. And once you have that, then why have the ICO? The ICO was really a cheap way to sell your idea to people who are willing to buy. And so this month actually was the lowest ICO volume in the last 17 months. That's what I was reading actually yesterday. So that's
good. Thank you, Yorgos. Tara, let me talk to you, and let's kind of put this in a broader context. Bitcoin is a type of cryptocurrency. Cryptocurrency is a type of blockchain technology. We've talked about, and I'm going to push back a little bit more about some of the advantages and disadvantages of cryptocurrency, but talk about the possibilities of blockchain technology, some of the applications that you see going forward, if not through currency.
Absolutely. So I think when you first come to this conversation, a lot of people tend to equate blockchain with cryptocurrencies. It's like for those of you in the room who may be old enough to remember when the internet first came around and there was email, a lot of people thought, okay, the internet is email because that's what you're doing with it, right? But then we started to realize there's so many more types of applications and other things you can do with the internet. So think of that with blockchain and cryptocurrencies. Cryptocurrencies were really the kind of first ubiquitous application that could run on a blockchain, but blockchain is so much more. It's really this underlying infrastructure, as Jacob was talking about, that allows cryptocurrencies to operate, but you can do so many other things. And I think it's worth taking just a couple minutes to really understand the difference between the two. So Jacob did a great job explaining cryptocurrencies. You basically have these peer-to-peer networks, these distributed networks, where people are transferring value and currency directly between each other. They're using cryptography to make sure that those transactions are secure. So they're replacing that central trusted authority. So you have no bank, you have no PayPal, you have no central trusted authority. You're replacing that with cryptography. But what results is you have this record of transactions that's sequenced, so it's time-stamped. It's immutable. You cannot change this record. And it's distributed. Everybody has a copy of it, right? And that's really powerful. But it doesn't have to be a currency or a value that goes into this ledger. You can have other types of transactions recorded. You can have information recorded. So you're basically getting a sequenced record of transactions or information that cannot be changed. So there's a number of really exciting potential applications of blockchain. So Jacob touched on some of them. And there's different ways to kind of break it down in terms of the types of applications. I generally think of it as a Venn diagram that kind of overlaps, but identity. Identity is so critical. What do you need when you walk in anywhere to get service, whether it's medical, financial? You need identity. There are over 1 billion people on Earth today that don't have any kind of formal identity from which they can access formal services, right? So blockchain gives you that ability to start to create identity in a secure, immutable way. So a digital identity, you don't have to have any papers, you can link it to biometrics, to other identifiers, to start to give identity. Another kind of whole class is what I call asset tracking, so that a lot of the supply chain management falls under there. But really, I always say, look, blockchain lets you take kind of supply chain management and turn it into almost a police chain of custody of evidence, because you have this record, this time-stamped, unchangeable record, and you can link that record either to a digital asset, or you can link it to something else. Jacob used the orange example. So there's a great example. So fisheries, right? It is amazing. I forget the exact statistic, but when you go to eat fish of a certain type, people have done studies that very often you are eating something completely different than you think you're eating, right? And so there's a great blockchain-based system that's been started that's being leveraged in Fiji, where they go and they fish for tuna. And literally on the deck of the ship, the moment they bring the tuna on board, they put an RFID tag in it, and then that's linked into a blockchain. And they start tracking where that tuna goes. So all through the supply chain. So when you're sitting in a restaurant somewhere eating tuna, they can show you that it really is tuna and exactly where it came from. And not just that it's tuna, that it was, that was fished legally and sustainably, right? That's really powerful, right? Think about aircraft parts, critical components. Today, if there's some kind of aircraft accident, generally what happens is the entire fleet of aircraft of a similar type are down. Whether, I have a long military history, whether it's in the military context, which can have major security implications, or from a commercial context, which can have financial and other kinds of implications. Imagine if you had this kind of tracking for every component in an aircraft, and you could very quickly pinpoint what it was that failed, and then maybe minimize in terms of the number of aircraft you're downing just to those aircraft that have bolts from the same lot. Think about the implications of that. So that's incredible. Then there's another whole broad category that I like to call enterprise efficiency. And really, I think this is what's going to actually drive the development of blockchain, because it is this peer-to-peer network, and it can be created in many ways. It can be created in these kind of permissionless and public systems, like you think about with Bitcoin, where anybody can join, or you can create it in ways where just in an organization or a group of organizations, you create a permission system where people have to have permission to join and maybe to see the ledger. Right? But you can take advantage of kind of just the transaction efficiencies from direct contact between entities, right? Kind of a financial example, if you go overseas and you take money out of an ATM, they're giving you cash because your bank has promised to pay that bank back. But the chance that your bank has a direct relationship with that bank is pretty slim. So your money may pass through a lot of intermediaries before it gets there. But if all the banks were linked into kind of a back-end blockchain system, that could happen instantaneously. Think of just the efficiencies of that system, right? And the final category that I like to look at is what I call smart contracts. And smart contracts are, you don't have to do them in blockchain, but they're very powerful in blockchain, where you're basically saying with a smart contract, it's kind of like an autonomous system. If something happens, then something executes automatically. Some code executes automatically. So think about disaster assistance. Right? FEMA potentially is interested in looking at, can I create smart contracts so if a federal disaster is declared, automatically, the moment it's declared, money and resources can be transferred to that locality when there's something coming in. Think about the hours and minutes and days before a hurricane. I mean, look at what we've seen with Hurricane Florence, what we're seeing in the Panhandle in Florida right now. What a difference does even a day or two or hours make in terms of getting resources on the ground through executing smart contracts? So these are the kinds of amazing potential applications you can get of blockchain. But I spend the rest of my time thinking about, okay, what could possibly go wrong? Think about putting people's information and how you start to develop identity systems in immutable, transparent records, right? Or any of these applications. There's a lot of things that can possibly go wrong. So the work that I've done at Georgetown, we launched something called the Blockchain Ethical Design Framework. And really, ethics sounds very esoteric, but to me, ethics in technology is you make what seem like very unimportant, innocuous decisions about designing and implementing technology, and they have huge resounding impacts in terms of the outcomes on people and communities, right? So we can talk more about it later, but there's so much potential, but you also have to be very thoughtful about how you're approaching this technology.
So I want to just ask Jurgis and Kara so quick follow-up questions we'll open up. Jurgis, if you are working in Venezuela, where inflation runs 1,000%, 10,000%, would you rather get paid in Bitcoin or Venezuelan dollars?
So the first answer is I wouldn't want to be in Venezuela.
Venezuela, right.
That's the first part, although it's a beautiful country. But clearly, that's you can think of it. Bitcoin might be the answer. And I remember when I was teaching this case once, somebody said, talk to the people in XYZ country. Exactly your point. but the question then becomes, if that's the case, why haven't we seen Bitcoin really
Right.
rising now, right? So if you look at transactions, there's only 2 billion.
Yeah.
That's really very, very small. Gold was per day. That was 200 something billion per day. So something happened, and people kind of said, okay, Bitcoin, I'm not interested.
Or I think about remittances. You have immigrants working in the United States sending money back to their home countries. And I recognize, as Jacob said, there's a huge transaction cost with Bitcoin. But if you go to Western Union and try to send your money to another country, there's a very big transaction cost there. Is this a potential vehicle for remittances? A much more
You mean
efficient?
Bitcoin?
Yeah.
I mean, in some countries, it's actually, Bitcoin is not allowed. And we're talking about some very big countries, like China. Mm-hmm. So it's going to be...
Because it's moving money outside the banking system.
Right.
Yeah.
Right. And so there is a question then, who can use Bitcoin? Can the average person have access to it, et cetera, et cetera? Mm-hmm. Whether it's dollars, it looks like people know what to do with them. So far at least.
Yeah. Carol, let me ask you a quick question. Blockchain as a technology for internet voting, is that a more reliable system than our current method of voting?
So what that gives you, potentially, and people are experimenting with this. They're actually in West Virginia of this year in the primaries, they did voting on a blockchain in a limited trial. They did 2 counties. They did overseas voters, so uniform voters and civilians living overseas. So it was a small trial. But the idea is that you can vote securely and electronically. If you think back to what Jacob was talking about it's really pseudonymous, right? So there is an identity there, but people can't link that identity to your identity, right? So you can track a vote just like this, asset tracking. It's a digital asset that you're tracking. Think of it kind of a police chain of custody of evidence. So you can see the tracking of that, but nobody knows it's your vote. But you have that confidence that your vote was counted. I was in the military for over 20 years. I voted by absentee ballot that entire time. I often did not have a lot of confidence that my absentee ballot was actually open, right? Because a lot of times, as far as I understand, it doesn't need to happen right away if it's not a really close race. But if I had that security of knowing exactly the traceability of my vote, that would be incredible. And think about the implications for democracy, which is what we're talking about, in terms of if you can lower those barriers to voting. If you had a secure way to vote on your mobile phone, that's incredible.
How about blockchain as an alternate to a social security number or some kind of PII that's subject to hacking? Is it a more secure system for transmitting, for verifying identification?
So blockchain allows you a completely different way of thinking about identification. So think about identification today. What is identification? What is your identity? It's really a collection of identifiers, these individual bits of information and usernames about you. And as we live more and more in the digital space, a lot of these are kind of these digital breadcrumbs that you leave. But government traditionally gave you your identity, right? You have your birth certificate issued by the government, your social security number. There's really a big movement on blockchain around this idea of self-sovereign identity, that you can be in control of your identity. So think about today, the credit agencies in this country, right? Equifax, Experian, TransUnion. Think of all that information about you that they have, and you're really the product, and they're selling that to other people, right? But with blockchain, you can create a system where you control that information and you get to decide who sees it. The example that's used a lot is, let's say somebody goes to a bar and they want to prove that they're over 21, so they hand their driver's license over. Well, the bouncer at the bar looks at all that information. What if that's your 21-year-old daughter or sister that's there, and the bouncer can now see their address, all this other information about her, whereas what does he really need to know? Just that she's over 21, right? So with blockchain-based systems, there are systems created that you can just give proof that you're over 21 without giving all that other information. So it's a really fundamental shift in terms of how identity functions. Now, it's a major shift, right? And shifts like that, a time will tell in terms of if we actually get there. But think about all the different identifiers. Your college degree. Well, MIT has launched a pilot where they're actually verifying your degrees on a blockchain system, right? And you can do something called zero knowledge proofs on a blockchain, which means I can show you a reliable proof that I have a social security number without giving you my social security number. And that's really powerful as well.
Good. Christina has a mic, and I want to give everybody a chance to ask a couple of questions. While Christina is making her way around, just if you want to ask a question, just raise your hand. Jacob, let me ask you one question. What is the future, quickly, of cryptocurrency? Like, if you don't believe this is a currency and it's not a security, I sort of look at this again, to Kara's analogy of the internet. The first thing that comes out of the internet is not where we are now. You go through many iterations. The 2.0, 3.0 version, where do you see this going? I'll give people a moment if you have questions. Okay, go ahead.
I think, as I mentioned on the first slide, actually, we think that the current cryptocurrencies, if they are supposed to survive and thrive in any imaginable future, they'll have to transform themselves. For example, for Bitcoin, there has to be that side chain that will allow retail transactions, which will be much cheaper. For Ethereum, for Bitcoin as well, the energy usage that's used to support that whole network has been climbing very, very steadily, and it's at the dimensions of a small country. I mean, it depends which day you look. Might be Switzerland, might be Ireland, etc. But again, you can argue that, well, traditional money also costs us something. We have to have the Fed, we have to have all these trucks tracking dollars around the country, etc. So there's a cost to it as well. But the point is, we could probably do it way more efficiently. And I think, for example, Ethereum, they're trying to move from proof of work to proof of stake, where you still have some kind of a lottery system, but your chips are not how much energy you're burning, but how much of the currency you actually own, because then you have an incentive to keep the system going. So there's a way to reduce the energy inefficiency and operate in a more efficient way. So I think if any of these are supposed to to thrive, they'll have to transform very significantly. And the other risk we see is a central bank will step in and introduce their own digital currency. So the digital future might actually be driven by some central institution. Again, it won't be that completely distributed system, but maybe that's not such a big problem, because at least we'll have one authority, somebody will be the last backstop that will regulate and make sure that the show will keep running.
Okay. Question, sir.
So it's my understanding that you can use Bitcoin to exchange currencies. So I tried to do this. I wanted to convert dollars to euros, and the limited number of people I know who knows anything about this could say, oh, it's really easy. But nobody could tell me how to actually take delivery of the hard currency, or how I got that currency. And also, I'm curious to who would be buying my dollars and providing me with the euros. Thank you.
Does anybody know the answer to that?
Yeah, so I think the way you would do it is you would talk to an exchange in the U.S. and you would give them dollars, they'll give you the Bitcoin, and then you would talk to a company that's an exchange in Europe, and then you will try to do you'll have to open an account with them, and then you will reverse the transaction, and you will not know who's going to buy your Bitcoins. It'll be somebody with a public address, unless you can associate that public address with a physical entity.
But who would it be, as an example? I wouldn't know them. Who might it be?
But it'll be a public address, so it.
And it would be individual, bank, or?
It can be individual. It can be a bank.
There's another question right there, sir.
Yes, I have a fundamental question on the identity issue. As a human being, I get recognized by how I look, or a number or something associated with me. I don't get what is in the blockchain, so that when I vote on my iPhone or do whatever it is that it's coming from me, what's in there and how does it check that it's really me that's asking it to vote for so-and-so or do any other information-related act?
So I think the first thing to understand is that blockchain is only ever one piece of a larger system. It's only one layer of a larger technology, and that technology is part of a larger system. Blockchain itself is not going to verify your identity when you sign up for one of these public addresses that Jacob is talking about, right? So you have to have some governance system that says, this is you, and you get a public public address that has a private key, right? So you're signing up, you have to have traditional governance mechanisms to do that. But once you have that, they call it a public-private key pair, you hold this private key, which is kind of like the key for a lock. Think of a mailbox, right? And people will know your public address, but they won't know it's yours, and you can open it. So that's the verification of your identity when you're an analog thing, connecting to this digital system is not done by the blockchain itself, right? So who does that? How is that done initially? And it's done in all different ways. And this is why what is so critical about blockchain is the governance. Blockchain is a system by which you set up a number of rules, and then the cryptography just validates that all of the data follows those rules. But people have to set up those rules, right? So this is what our framework is all about, this blockchain ethical design framework, is it's these different areas where it's critical to think about when you're designing and implementing the technology, and governance is always the #1 item, because how you set up those rules, blockchain is not a panacea. It is a tool like any other technology, and it's a tool for people to use for different applications, right? But it's how that technology intersects with people that's interesting. And so that's why the governance rules you set up are so important. I didn't hear you, sir.
Is that a social security number?
It's not the same thing as a social security number, but it's that idea of you have a unique identifier that now is a public-private key pair.
But let me just go, and I think it's interesting. Have I basically just traded a social security number for a private key? Then the private key will not only have all my financial transactions, as Jacob said, it'll now say how I voted as well. Or do I have multiple private keys?
You can do it in a way that all those different pieces are disassociated.
Sir, let me go back there.
Yeah, so Kara, to kind of the conversation we were just having, Estonia is really kind of the forefront here of how a government should think about designing this ethically. I know it's nebulous, but is there any pointers or tips or best practices the United States should be thinking about adopting along the lines of Estonia, another country that's a little bit more forward-looking in terms of blockchain as society overall?
What's interesting about the Estonia example, so for those of you who don't know, Estonia basically went to an e-governance system quite a while ago, and it actually predates blockchain, right? So they were moving a lot of their citizen services electronically. But they are very interested in, or in the process of moving those into blockchain-based systems. But blockchain is a pretty complicated technology. There's cost involved, so there has to be a really compelling reason. And one of those compelling reasons is taking advantage of some of the unique characteristics of blockchain. It could be the efficiencies that we talked about before, but it could also be the secure immutability. Estonia, really, if you look into what the motivation was, they were worried about the future of their democracy and meddling by Russia into their systems, right? And so by putting this data onto a blockchain, nobody could break into and change data in a central data repository that would then create confusion, potentially creating new identities for citizens, et cetera, because this data is now distributed in this blockchain that's this immutable record. So it's very interesting, I think, when you start to dig into the different contexts of these examples of what the underlying motivation is. And to me, the biggest lesson learned is understanding the applications where you can really leverage those unique characteristics of blockchain. Because it's big, it's complex, the technology is still evolving very quickly. So I always say, go slow and, understand it, learn about it, explore, go slow, but understand those applications where it's really worth moving to blockchain.
We have a couple minutes left. Let's take this one last.
So I guess it sounds like a lot of these revolutionary opportunities for blockchain might have dependencies on other kind of institutional developments like voting infrastructure, banking payments infrastructure, and AT&T, Verizon, Apple, Samsung, et cetera, to kind of integrate all of these things so that these things are possible. I mean, I guess for any of the panelists, do you guys have views on how well or not, if that's the case, these kind of other these other hardware and software and database infrastructures are kind of keeping up or keeping along, and if not, kind of what are kind of the biggest impediments to those, to that happening, kind of moving forward? Thanks.
Okay.
Well, what I would jump in and say is I can't comment kind of on the state of any given industry per se, but those are absolutely the kinds of things that you need to be asking. right? So I always say in terms of the work that I've done around the ethical design framework, really it's a thoughtful design framework. I don't have the answers for you, but I have lots of questions you should be asking along the way. And a lot of it is this very ecosystem focused. Understand the context of the entire system where you're trying to introduce the technology. Who are all the stakeholders? What are the relationships between those stakeholders? What is the existing infrastructure, whether it's technical, the financial, the legal and regulatory, right? These are the questions that in any given context you need to ask.
Let's take this one last question and then we'll wrap up.
Okay, we're all here. We're all a bunch of good friends. We're a small, intimate gathering. We've got a guy from Goldman Sachs here. How do we invest in this technology and make money? So Chris can recover the $65 he lost on his investment. But
Well,
what
actually, and let me take this, like, is this like we are at the advent of the internet? Is that what we are facing right now? I don't anyone.
Are you trying to hold on to your Bitcoin?
I'm trying to, yeah. I've basically given up my Bitcoin, but where, and maybe this is actually a good sort of where, make a prediction about where this goes. What makes you optimistic? What's the application that you think is most relevant?
And include symbols if you want to.
Right, exactly.
What's fascinating is there's 2,000 plus currencies out there. There's only 2 or 3 that are liquid. So it's not like people are not trying to create new stuff. The question is, and even the one that Bitcoin that we'll know is not that liquid. So I think it's more the question, like, what is the next thing that people are going to do? And there's even a currency that basically says, we're all going to be, there's no pseudonymous, everybody's known, we're in line with the central banks, etc. We're going to have the clean crypto, which is an oxymoron. We're going to have the clean crypto out there. And that also doesn't seem that, I don't know, Jacob, you probably know more about this. It hasn't caught on either, right? Because it's too clean, maybe.
I think there are huge opportunities, but there are massive risks as well. So I would say, as with any investment, if you really want to invest into something, you have to do a massive amount of due diligence. And so there might be opportunities in the ICOs, there might be good ones, there might be bad ones, unless you do the due diligence or have somebody trusted to actually talk to the companies, do all the background checks, etc. You cannot be sure. Eventually, what will happen is, if you believe in the technology, as we believe in the technology, you should look for the companies that are early adopters. So certain companies are much more active in that space, and if you believe that is going to be the future, and that's going to, the blockchain and all this new technology is going to get more traction, you can look at companies that are extremely active in that space and gear your investments towards that.
Companies like?
I can't name names, but they're very large.
We'll do that part off the record.
There are very large retailers. There are traditional technology companies that have looked at it. There are consulting companies that are very active in that space. So I think I can say as much.
Kara, let me give you the last word. A blockchain application that you are most excited about, let's just say in the short term, because obviously there are long-term implications that we don't understand.
I think asset tracking, especially for digitally native assets, so things that are digital, right? I have a long history in the Navy. The Navy is looking at additive manufacturing or 3D printing in theater. But if you design something here in the United States and you want to send a file to have them create something really critical out somewhere in the world, you want to make sure that file gets there in a way that you know it was not in any way changed, right? So blockchain is really good at these kinds of things in terms of doing this supply chain management, especially for digitally native assets where you don't have those issues of, how do I verify that I'm me going into this digital system?
Before we conclude, let me just give the panelists, I'm very big on letting people plug things. Anything, Yorgos, anything you want to plug? We should also say people are watching this on Facebook Live, so it's not just the people in the room. Anything, Yorgos, you want to plug?
We're at the Miller Center, so I should watch it. Okay. Oh, there you go. So here's my co-author in many cases. We have a conference at Darden, which is the University of Virginia Investing Conference, November 9th. November 9th, where I'm actually going to get to be Chris. So that's good. I'm gonna be asking. I'm gonna be asking the questions instead of having to answer anything. And it's the 10-year anniversary of the crisis, so that should be very fascinating.
Kara, anything you want to plug?
I would just say if you're interested in how to build better blockchains, we do have this blockchain ethical design framework, and if you Google that, it'll come up. It's on the Georgetown site. And there's more information about some of the stuff that we talked about today that can help, illustrate some more of these kind of what could possibly go wrong, but then give tools to ask the right questions to try to prevent these issues.
Jacob, plugging Goldman Sachs?
We publish a lot of research, so you can look at our research, and it's a fascinating area, and we believe that the technology is the future. That's the message, and I'm very happy to answer any questions afterwards.
Well, look, this has been a fascinating conversation, and as you can tell, we've just barely scratched the surface, but hopefully after an hour and 15 minutes, you have a better understanding of both the opportunities as well as some of the challenges with this broader technology. And I'm sure once the cameras go off, if you want to come up and ask questions about more specific investment advice, our panelists might be a little bit more candid. But please join me in thanking them for their